Good evening, everyone. Time for another silver update. You are looking at the daily chart, and of course the key indicator here is the daily MACD. You can see that we've crossed over the zero line, which has resulted in a positive move of the red line through the blue line. In the past, there's one of two scenarios that you can have. You can see the positive crossover we had here resulted in a very strong rally, as well as here we've got the record-breaking rally that ended near $50 an ounce. But we also have the May smackdown, which resulted in a crossover right here, and that ended up correcting back down, crossing a little bit over to the downside, consolidating, and then having a rally breaking out of that. Not into new highs, but up to about 44 or so, and then we corrected down. So the key question is, will we rally up and reverse and cross over to the downside? That's a possibility, and I'm going to cover Clive's latest article where he seems to think that's going to be the case. But if we do that, we want to go out and look to the weekly. We can see that the red line has now crossed significantly into negative territory down at negative 0.47. The blue line is still falling. If we do get some type of reversal and a continuation down, I'm assuming down below perhaps the low that we set at 26 and a test of 21.5 or so. If we do that, then we are probably looking at a reset of the weekly MACD down below this point, which was the low we reached in 2008, which was roughly $8.50 an ounce, and that was the lowest we had for the last 15 years, according to this chart. So that would represent an incredible buying opportunity if that happened. I still think that it's unlikely. I expect a bounce here somewhere soon. But if we look at the daily, we haven't crossed over in the same manner that we cross on one of these continuation rallies. So it's starting to shape up to look more like this crossover than these other two. So will we get a continuation consolidation pattern up in here? Or will we get a complete snapback rally, or will we go to lower lows? We'll have to wait and see. I wanted to look at that Clive Mond article because there's some very interesting things in it. First of all, Clive has reversed himself, which is very interesting. He says, "It now looks like we were a little too bullish in the last update, for the way silver has acted over the past week suggests that another sharp drop is imminent before the dust finally settles on this reactive phase that is likely to take it to or some way below its recent panic lows. On silver's 4-month chart, it is now apparent that a bear pennant has been forming since the panic bottom, with the weak upside volume portending an imminent breakdown and steep drop." Now I forgot to point out to you, on the 8-hour, we can see that we're getting a kind of a rolling over here of this MACD as it approaches the zero line. So this does tend to agree with what Clive is saying, although we're about to cross through this line. If we solidly cross up to the positive, then we could have something more like this, as opposed to where we crossed up, say, in here and we had a little rally and consolidated, or in here we had a little bit stronger rally, but nothing like the rally we had here or the rally that we had back here. So this line is key right now, whether it's going to turn down, roll over, or whether it's going to continue up through that zero line. So back to Clive. He's seeing patterns, and he's seeing a invalidation of the doji dragonfly that he saw. One of the reasons, he says, is because this doji, he points out that this doji occurred out of hours. So he's saying something to the effect that this may not be a real bottom put in. So this is the pennant that he's referring to. And I don't really put a lot of stock in these types of formations. They're interesting to point out, but they only have a percentage chance of being correct. They're not always correct, so I don't put a lot of stock in those. But the main thing I wanted to look at in Clive's article, and I'll link it so you can read it, is this, what he says about the crash JP Morgan campaign. This is very interesting. He says, you may recall that there was much talk earlier this year amongst silver bugs about JP Morgan's massive silver short position and their cheerleaders encouraging them to believe the fantasy that they could bring down JP Morgan by buying physical silver, as expressed by the picture below, which was doing the rounds at the time. The idea that a motley bunch of small, highly leveraged speculators can bring down an entity like JP Morgan is, of course, laughably naive. Now, where did he get the idea that it was a bunch of small, highly leveraged speculators, when he says right up here that the campaign to bring down JP Morgan was by buying physical silver? So I don't know where Clive is getting this idea. I don't know anybody who proposed that small speculators should go out and highly leverage themselves to try to bring down JP Morgan. If I remember, the campaign was for everyone, small, medium, and large, to stack physical silver, to take it off the market, and to create a delivery crisis so that it would cause the COMEX to be busted and JP Morgan to be exposed. So that's a very strange way to look at things, and it's, in my mind, a little bit suspicious, and I'm starting to have doubts about Clive and where he's coming from. But let's continue. Can bring down an entity like JP Morgan is, of course, laughably naive. And what is in fact has happened is that the big players have turned the tables on the small speculators by using their leverage and margin against them. They organized the two massive silver takedowns, one in early May and the other just finished, aided by friends in high places hiking margin requirements to run them out of their positions by triggering their stops and margin calls, and then covered their shorts at the resulting low prices. Now, a lot of people are saying that JP Morgan covered their shorts. JP Morgan apparently and HSBC and the other big shorts. I really have my doubts about that as to whether or not that's the case. I guess we'll see when the commitment of traders numbers are put out of whether that's the case. If that's the case, that's tremendously bullish for silver. I can't imagine, if there aren't the gigantic paper shorts hanging over the market, why there wouldn't be a tremendous number of speculative longs coming in to the market. And he says, thus the latest commitment of trader charts reveal the big money has largely cleared out of its short positions in silver, which is mega bullish, with the dramatic drop on the last route being a sign that we haven't got much further to go before silver reserves possibly reverses, possibly dramatically to the upside, and this is a train that will leave the station without all the get-rich-quick merchants that were strutting about proudly earlier this year. Now, again, I don't know what he's talking about here. I don't remember anybody proposing that buying physical silver was a get-rich-quick scheme. Now, I myself have projected that eventually the price of silver will be in 4 digits, but I never said anything about it being get-rich-quick. I've been investing in silver for over 10 years, and I know most of the silver bulls have been in at least that long or longer, and I don't know any of them who have proposed that it's a get-rich-quick scheme. So again, I don't know what Clive is referring to. And of course he says they will be left behind lying face down in the dirt. Apparently they're going to be out of the market. Well, I don't know anybody who's been stacking physical silver that is out of the market. So here's the commitment of traders, and you can see that this number right here is one of the lowest you have in this series. This is of course just 2011, so it doesn't go way back, but you can see that it's very, very small, so that's what he's basing that on. The commitment of traders chart above shows an astounding drop in the commercial short position in silver over the past several weeks, which is viewed as hugely bullish. And he goes on. So Clive thinks that the price is going lower. He may be right. I have my doubts, and with these statements that he's made, I also have my doubts about either his motivation or his knowledge, because obviously the takedown JP Morgan campaign is a long-running physical silver stacking campaign, and it has nothing to do with small speculators using leverage and margin. So I'll link that and you can read that. The next article I wanted to go to is, I think, a much more important article about the long-term outlook for silver, and this is an article that appeared on Zero Hedge. It's by S.R. Srocco, and it's called Peak Silver Revisited: Impacts of a Global Depression, Declining ore grades, and a falling EROI. Now, he is projecting that we are going to reach peak silver fairly soon, and I don't have time to read the entire article, but I'm going to go through some of the charts and try to explain it to you. The first one he does is he gives you a chart of world silver and oil production from 1900 to 2010. Excuse me. And you can see the similarity in these charts. They don't exactly mirror each other, but you can see that starting around in 1950, the production of both oil and silver skyrocketed. Now, oil had quite a pullback in the mid-70s. Silver, not so much. It peaked around the peak of the $50 silver, $850 gold peak, and then fell off, but then silver just kept up. The other key difference, you can see that peak oil has apparently occurred since around 2009 or so. And then he goes into the reasons of this. Now, I don't necessarily buy into the peak oil theory. I know a lot of people propose that, and the idea with peak oil is that a lot of the easy to find oil is gone, and that there isn't nearly enough oil left. And he actually deals with that argument, which is one of the better peak oil articles that I've read. And the main thing he concentrates on, instead of a lack of oil and oil shale and other things being out there, is he talks about EROI. And EROI is energy returned on invested. And basically what that concept is how much energy does it take to get 1 unit of something. So if you get 10 units of something, 10 units of oil, for example, how many units of oil does it take to get those 10 units? And his argument is that the EROI is falling and has been continuously falling, and you can see some charts here that he gives. This one's on world production peaks, and we're going to skip the export land model. Here's a chart on the EROI trends, and the point that he's making with oil is that when oil was first being drilled, especially in the United States and other countries as well, it's the easiest oil was taken out first. So the high pressure gushers and things like they had in Texas and the original find in Saudi Arabia and stuff like that, those took a minimum amount of energy expended to extract the amount of energy out of the ground. So that's what this chart represents. And he's saying that eventually we're heading to an EROI of 1-to-1. In other words, you're going to need to expend a barrel of oil to extract a barrel of oil. Of course, if that's the case, then that's end game. Because what's the point of expending a barrel of oil to extract a barrel of oil? So he goes on to apply that idea to silver, and he's still in the oil situation here. Here's the chart where the oil peaks, and this is Hubbert's peak, and the EROI is calculated here, and you can see that this dark blue area is where it begins to expand as the amount of oil is pulled out decreases. So we get to the point where we're spending a tremendous amount of energy to get less and less energy out of the ground. Now he's showing, this chart shows the number of countries that have already passed peak oil. He gives the dates, and you can see the United States and Texas, United States, Alaska were some of the first to pass peak oil. This is where your conspiracy theorists are going to say, actually, no, that's not the case. They just simply stopped and capped most of their oil and let the rest of the world do that. So he talks about that theory a little bit, pretty much dismisses it, but we'll have to wait and see how much oil has actually been capped. But the main thing we want to get to is the silver production. And he cites two arguments, three actually, but the two main ones I'm going to look at have to do with the EROI of silver and the ore, the quality of the ores. Now this first chart is the top 8 states' peak year of silver production. So you can see that these states are marked in the different colors here, and you can see that Colorado and Montana actually peaked all the way back in 1893, and then is it Nevada 1915, and if you remember the Comstock lode, we've talked about that before. Utah peaked around 1925, and the two late ones that we have actually are Idaho and, is that Nevada or is that New Mexico? I'm not sure which one that is. I think it's Idaho and Nevada are the two ones that we have that are still producing the most. So the point of this argument is that, and we'll get down to the ores here, that as the quality of the ores decrease, the amount of silver that we get for the amount of ore that is processed gets smaller and smaller and smaller. So that's this last chart here that we're going to look at. This is USA and Idaho silver ore grades 1940 to 1989. And this is the number of ounces per ton that were yielded based on those grades. And you can see how this, back in around 1950, Idaho especially, but the USA in general, were getting a large number of ounces per ton. You can see it peaked at about 30 ounces or so that they were getting per ton. And we're all the way down to about 3.8 or so ounces of silver yielded per ton. So the question is, why is this falling? Now, there have been a lot of theories speculating why the quality of the ores is dropping. One of them is, that I've heard bandied about, is that silver is a much, much lighter metal, and therefore the very highly concentrated ore bodies that have high concentrations of silver were much closer to the top and therefore much easily mined. And I've heard some other explanations, but I think that's probably the best one. This chart is about Hecla's Lucky Friday mine, and you can see he does two comparisons. He shows you how much ore has been milled and how much silver has been produced. And you can see back in 1965 they milled 181,000 tons, and in 2010 they milled 351,000 tons. and that's a 94% increase. But the silver that was produced went from 3.2 to 3.3, only a 4% increase. So the silver ore grades have decreased 42%. So this is the same sort of idea that the quality of the ore is decreasing. All of the easily milled ores have been used up, and they're having to mill the worse and worse ores, and therefore they're yielding less and less silver per ton that is milled. Now, we haven't looked at the EROI yet, because you have to remember that the costs of this milling of this ore also are increasing. So not only is the yield of silver in the amount of ore decreasing, but the cost of milling it is increasing. So those are the two factors. Now, his main theory is that when the depression that he projects hits, when that happens, the silver mining will be drastically impacted, and that's because we'll see in a chart below of how silver is mined as a byproduct compared to gold. But in this chart, this is a really dramatic chart because it actually has 1935, 1970, and 1993. And you can see that back in 1935, silver ores yielded 1.35 ounces per ton, while in 1993 it was 0.11 ounces per ton. So that's a 92% loss in quality in the ore. Now he talks about the EROI. He talks a little bit about modern farming and how it's said to be so much more efficient, but he debunks that and shows you that it's actually not. It's based on cheap energy. A long article, you'll have to read that. He also gives a chart of production of silver during the Great Depression, and you can see that the production of silver in the world and the United States dramatically fell off during the Great Depression. While if you compare that to the production of gold during the Great Depression, it actually increased significantly, almost doubled, whereas silver dipped almost 35% and then ended up the same. So big difference between those two. And this is the chart that I was referring to prior, and that's the one that shows that silver as a percentage of primary production versus base metal production is much, much smaller. You can see that 80% of gold that's mined is mined as a primary. So it's pulled out of gold mines, they're mining it for the gold, and then the base metals are a 20% byproduct. On the other hand, silver, only 30% of silver is mined as the primary object of the mining, while 70% of the silver that we get comes out of base metal mining. The reason why that's important is because if we look at what he is projecting for the coming economic situation, he's saying that as global economic growth disintegrates, he's projecting another depression. As global economic growth disintegrates, so will the demand for base metals. And I've showed that in some of my previous videos, which show that the stockpiles of copper, lead, zinc, and other base metals are absolutely going through the roof. They're at the highest levels in history that we've ever seen. And so if we have some kind of drop off the cliff economically, then 70% of the silver that's mined potentially could go away. On top of that, silver ore grades are relentlessly falling in mines throughout the world, which takes an increasing amount of energy just to keep production flat. If the mining industry tries to incorporate some more human and animal labor to offset declining oil-based energy in the future, it will do so only at a much slower rate of production than today. This is due to the fact that human or animal labor cannot match the extraction rate of diesel-powered excavators or huge dump trucks when it comes to mining silver. Then there is a negative effect of global depression on the production of silver. Presently, the world has entered into tremendous chaos and economic turmoil. Conditions are ripe for a complete disintegration of the financial markets. thus pushing the world over the edge into a new dark age of hyperinflationary depression. In this sort of atmosphere, countries may resort to the nationalization of mines as well as other protectionist policies. When the nails of the peak silver coffin are added up, the death of increasing future supply is close at hand. The CEOs and analysts in the mining industry are for the most part oblivious to these factors that will destroy their ability to make viable forecasts of future projects. It amazes me to see professionals plan a huge open pit mine with a 25 to 45-year economic plan without any consideration of what the energy environment will be like at that time. For some strange reason, there is this false assumption that if we build it, the energy will come. If the world enters a depression within the next year or two, this will certainly guarantee the global peak of silver production. Why? It won't matter if the global economy recovers in the next decade, because the peaking of oil and the falling EROI of energy will have destroyed enough net energy to kill any attempt to bring global silver production back to the level it was before. Lastly, anyone who is good at connecting the dots will realize the ramifications of this article go way beyond just the peaking of silver. The falling EROI of energy will not only be a destroyer of precious net energy, but will also help bring down the largest empire in the world. This will be the subject of a future article. So, fascinating article. He makes some really good points. There's some really good charts. I think the main takeaways from this article are that, and I pointed this out before, that the ores of silver have drastically declined in quality, and therefore the direct silver miners are not in the position that they were before, and that's why such a small percentage of silver is mined directly in silver mines. The other takeaway is the EROI and how the cost of energy, the cost of getting energy, and then the ultimate rising cost of energy itself will also cause a squeeze on the mining of silver. And then finally, if there is a serious downturn in the world economies, which, by the way, the price of silver is the greatest harbinger of. If we look at crude oil, we can see that we actually have a rally in crude oil. We don't have the type of decline in crude oil that we've had in silver, but they're close. So if these are projecting a depression or severe recession coming in the future, then combined with the tremendous stockpiles of base metals, we may end up with a peak silver situation where it's just too expensive and nearly impossible to mine silver at current prices. And of course, that's going to end up with an explosive silver price. And we'll talk to you next time.